Question 1. The analysis reveals that a financial advisor in South Africa is meeting a new client for the first time to establish their investment risk profile. Which of the following methods would best ensure compliance with South African regulatory requirements and ethical best practices for risk assessment? Option A. Administer a standardized risk questionnaire and rely solely on the numerical score generated to determine the client's risk tolerance. Option B. Conduct a detailed interview covering the client's financial goals, time horizon, investment knowledge, and emotional reactions to market fluctuations, supplementing a standardized risk questionnaire. Option C. Infer the client's risk tolerance primarily from their age and stated annual income, without extensive verbal probing. Option D. Base the risk assessment on the advisor's own comfort level with different investment strategies and products. Correct answer is B. Conduct a detailed interview covering the client's financial goals, time horizon, investment knowledge, and emotional reactions to market fluctuations, supplementing a standardized risk questionnaire. Explanation. The analysis reveals a scenario where a financial advisor in South Africa is tasked with assessing the risk profile of a new client. This is professionally challenging because accurately gauging a client's risk tolerance is foundational to providing suitable financial advice, directly impacting the client's financial well-being and the advisor's compliance with regulatory obligations. Misjudging risk can lead to unsuitable investments, potential financial losses for the client, and breaches of fiduciary duty. The best approach involves a comprehensive, multifaceted assessment that goes beyond superficial questioning. This includes a detailed discussion of the client's financial goals, time horizon, understanding of investment products, and their emotional response to market volatility. This approach is correct because it aligns with the principles of the Financial Advisory and Intermediary Services Act, FIS Act in South Africa, which mandates that financial advisors must act honestly, fairly, and with due skill, care, and diligence in the best interests of their clients. Specifically, Section 7 of the FIS Act requires advisors to gather sufficient information about the client's needs and circumstances to make appropriate recommendations. Ethically, this thoroughness demonstrates a commitment to client welfare and professional integrity. An approach that relies solely on a standardized questionnaire without further discussion is incorrect. This fails to capture the nuances of a client's risk perception and can lead to an inaccurate risk profile. The FIS Act requires more than a tick-box exercise. It necessitates a qualitative understanding of the client. Ethically, this superficiality breaches the duty of care owed to the client. Another incorrect approach is to assume a client's risk tolerance based on their age or stated income alone. While these factors can be indicators, they are not determinative. A younger client might be risk-averse, and an older client might be willing to take on more risk. This approach ignores the individual's unique circumstances and psychological disposition towards risk, violating the spirit and letter of the FIS Act suitability requirements. A further incorrect approach is to base the risk assessment primarily on the advisor's personal investment preferences. The advisor's own risk appetite is irrelevant to the client's needs. The FIS Act clearly mandates that recommendations must be based on the client's profile, not the advisor's. Ethically, this is a significant conflict of interest and a failure to prioritize the client's interests. Professionals should employ a decision-making framework that prioritizes client centricity. This involves actively listening, asking probing questions, observing nonverbal cues, and documenting the entire assessment process. The advisor should always seek to understand the why behind a client's responses, not just the what. This iterative process ensures that the risk assessment is robust, compliant, and truly serves the client's best interests. Question 2. Comparative studies suggest that when assessing a client's risk tolerance in South Africa, financial advisors often encounter a discrepancy between a client's stated comfort level with risk and their actual capacity to absorb potential losses. Considering the regulatory framework governing financial advice in South Africa, which approach best addresses this common challenge? Option A. Solely rely on the client's initial statement regarding their risk tolerance, assuming their self-assessment is accurate and sufficient for recommendation purposes. Option B. Prioritize investment products with the highest potential returns, assuming the client is willing to accept significant risk for greater gains, without a thorough assessment of their actual risk capacity. Option C. Conduct a comprehensive needs analysis that includes a detailed discussion of the client's financial situation, investment objectives, knowledge, and experience, and then objectively assess their capacity for risk, cross-referencing this with their stated tolerance. Option D. Recommend only the most conservative investment products available, regardless of the client's stated goals, to mitigate any potential for client dissatisfaction due to losses. The correct answer is C. Conduct a comprehensive needs analysis that includes a detailed discussion of the client's financial situation, investment objectives, knowledge, and experience, and then objectively assess their capacity for risk, cross-referencing this with their stated tolerance. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a financial advisor in South Africa to balance the client's stated risk tolerance with objective risk assessment, while also adhering to regulatory requirements for suitability. The advisor must avoid simply accepting the client's self-assessment at face value, as this could lead to recommendations that are not truly appropriate, potentially exposing the client to undue risk or failing to meet their financial objectives. The Financial Advisory and Intermediary Services Act, FIS Act, mandates that advisors must conduct a proper needs analysis and ensure that recommendations are suitable. Correct approach analysis. The best professional practice involves a comprehensive risk assessment that combines the client's stated risk tolerance with an objective evaluation of their financial situation, knowledge, and experience. This approach, which involves a detailed needs analysis and a discussion of various risk profiles and their implications, is correct because it directly aligns with the requirements of the FIS Act. Section 7 of the General Code of Conduct, under the FIS Act, mandates that financial services providers must conduct a proper needs analysis to ensure that any recommendation made is suitable for the client. This includes understanding the client's financial situation, investment objectives, needs, and the risks they are willing and able to bear. By cross-referencing the client's stated preference with an objective assessment, the advisor fulfills their fiduciary duty and regulatory obligation to act in the client's best interest. Incorrect approach is analysis. Accepting the client's stated risk tolerance without further investigation is professionally unacceptable because it bypasses the mandatory needs analysis required by the FIS Act. This approach risks making unsuitable recommendations, potentially leading to financial harm to the client and regulatory noncompliance. Recommending only low-risk investments because the client expressed a slight concern about volatility without exploring other options or understanding the client's broader financial goals is also professionally unacceptable. This is a failure to conduct a thorough needs analysis and may prevent the client from achieving their objectives due to overly conservative investment choices. Focusing solely on the potential for high returns without adequately assessing the client's capacity for risk is professionally unacceptable. This approach neglects the critical element of risk tolerance and suitability, potentially exposing the client to losses they cannot afford or emotionally handle, and contravenes the FIS Act's emphasis on client protection. Professional reasoning. Professionals should adopt a structured approach to client engagement. This begins with understanding the client's stated preferences, but critically, it must be followed by an objective assessment of their financial capacity, knowledge, and experience. The advisor should then explain the implications of different risk levels in relation to the client's goals and the available investment options. This iterative process ensures that the final recommendation is not only aligned with the client's stated wishes, but is also genuinely suitable and in their best interest, thereby satisfying regulatory requirements. Question 3. The investigation demonstrates that a financial advisor in South Africa is meeting a new client for the first time to establish their investment risk profile. Which of the following approaches best ensures compliance with South African regulatory requirements for providing suitable financial advice? Option A. Basing the risk assessment primarily on the client's current income level and the total value of their assets. Option B. Conducting a detailed risk assessment questionnaire that covers financial knowledge, investment experience, and financial goals, followed by a structured interview to explore the client's attitudes towards risk, understanding of potential losses, and emotional responses to market volatility. Option C. Relying solely on a brief, standardized questionnaire that asks a few general questions about investment preferences without any follow-up discussion. Option D. Prioritizing the client's stated desire for high returns and quickly proceeding to recommend investment products that offer aggressive growth potential. The correct answer is B. Conducting a detailed risk assessment questionnaire that covers financial knowledge, investment experience, and financial goals, followed by a structured interview to explore the client's attitudes towards risk, understanding of potential losses, and emotional responses to market volatility. Explanation. The investigation demonstrates a scenario where a financial advisor in South Africa is tasked with assessing the risk profile of a new client. This is professionally challenging because accurately gauging a client's risk tolerance is fundamental to providing suitable financial advice. Yet it is inherently subjective and can be influenced by various factors, including the client's emotional state, understanding of financial markets, and personal circumstances. A misjudgment can lead to inappropriate investment recommendations, potentially resulting in significant financial losses for the client and reputational damage for the advisor. Careful judgment is required to navigate the nuances of client interaction and to ensure the assessment is both thorough and objective. The best approach involves a multifaceted assessment that combines objective data with subjective client interaction. This includes a detailed questionnaire covering financial knowledge, investment experience, and financial goals, coupled with a structured interview to probe deeper into the client's attitudes towards risk, their understanding of potential losses, and their emotional reactions to market volatility. This comprehensive method aligns with the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, which mandates that financial services providers act honestly, fairly, and with due skill, care, and diligence in the interests of their clients. Specifically, the General Code of Conduct under FIS requires advisors to gather sufficient information about a client's needs, financial situation, and objectives to make suitable recommendations. This approach ensures that the risk assessment is not merely a tick-box exercise, but a genuine understanding of the client's capacity and willingness to take on risk. An approach that relies solely on a brief questionnaire without further discussion is professionally unacceptable. It fails to capture the nuances of a client's risk tolerance and may lead to an inaccurate assessment. It neglects the FIS Act's requirement for due skill and care, as it bypasses the opportunity to clarify ambiguities or probe for deeper understanding. Another unacceptable approach is to base the risk assessment primarily on the client's stated income and assets. While these are important factors, they do not solely determine risk tolerance. A client with high income and assets might still be risk-averse, and vice versa. This approach overlooks the subjective elements of risk perception and emotional response, which are critical for a holistic assessment, and contravenes the spirit of the FIS Act's requirement to understand the client's overall financial situation and needs. Finally, an approach that prioritizes securing a large investment amount over a thorough risk assessment is ethically and regulatorily unsound. This suggests a conflict of interest, where the advisor's personal gain may supersede the client's best interests. This directly violates the FIS Act's principles of acting honestly and fairly and in the best interests of the client. Professionals should employ a structured decision-making process that begins with understanding regulatory obligations, e.g., FIS Act requirements for suitability and client understanding. This should be followed by a systematic data-gathering phase, incorporating both quantitative and qualitative methods. Crucially, this must be complemented by active listening and probing during client interactions to uncover underlying attitudes and perceptions. Finally, the advisor must critically evaluate the gathered information to form a well-reasoned risk profile that genuinely reflects the client's circumstances and preferences, ensuring that all recommendations are suitable. Question 4. Analysis of a client's financial situation in South Africa reveals they have limited investment experience and a modest income, yet they express a strong desire for high-growth, potentially volatile investments. Given these circumstances, which approach best aligns with the advisor's professional and regulatory obligations under South African law? Option A. Prioritize the client's immediate desire for high returns by selecting the most aggressive investment options available, assuming their stated risk tolerance indicates they can handle the associated volatility. Option B. Conduct a comprehensive risk assessment that objectively evaluates the client's financial capacity, investment knowledge, and experience, and then recommend investments that are suitable based on this holistic understanding, even if it means moderating the client's initial high-risk preference. Option C. Proceed with recommending the high-growth, volatile investments as requested by the client, as their stated risk tolerance is the primary factor in product selection. Option D. Rely entirely on the client's self-declaration of risk tolerance and investment experience, without conducting any independent assessment or providing guidance on potential risks. Correct answer is B. Conduct a comprehensive risk assessment that objectively evaluates the client's financial capacity, investment knowledge, and experience, and then recommend investments that are suitable based on this holistic understanding, even if it means moderating the client's initial high-risk preference. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a financial advisor in South Africa to balance the client's stated risk tolerance with a potentially more objective assessment of their actual capacity to absorb risk, especially when considering the client's limited investment experience and the volatile nature of the proposed investment. Misjudging this can lead to significant financial harm to the client and regulatory repercussions for the advisor. Correct approach analysis. The best professional practice involves conducting a thorough and objective risk assessment that goes beyond the client's stated preferences. This approach involves a comprehensive evaluation of the client's financial situation, investment knowledge, experience, and their ability to withstand potential losses without jeopardizing their financial well-being or achieving their stated financial goals. In South Africa, the Financial Advisory and Intermediary Services Act, FIS Act, and its associated General Code of Conduct mandate that financial advisors act in the best interests of their clients. This includes ensuring that any recommended product or strategy is suitable for the client, which necessitates a robust understanding of their risk profile, not just their stated tolerance. The advisor must document this assessment thoroughly. Incorrect approaches analysis, recommending the investment solely based on the client's stated risk tolerance without further investigation, fails to meet the fiduciary duty imposed by the FIS Act. The client may express a high tolerance for risk due to a lack of understanding of potential downsides or a misunderstanding of the investment's complexity. Proceeding without a deeper assessment risks recommending an unsuitable product, leading to potential financial losses for the client and a breach of regulatory requirements. Similarly, prioritizing the client's immediate desire for high returns over a prudent risk assessment is a direct contravention of the best interests of the client principle. The advisor's role is to guide the client towards suitable investments, not to facilitate potentially detrimental choices based on short-term desires. Finally, deferring the entire risk assessment to the client's self-declaration without any advisor input or verification is an abdication of professional responsibility. The FIS Act requires the advisor to exercise due skill, care, and diligence, which includes actively assessing the client's risk profile. Professional reasoning. Professionals should adopt a structured approach to client onboarding and suitability assessments. This involves a multifaceted evaluation that includes understanding the client's stated goals and risk tolerance, objectively assessing their financial capacity to absorb risk, considering income, expenses, assets, liabilities, and dependents, evaluating their investment knowledge and experience, and considering the nature and complexity of the proposed investment. This comprehensive approach ensures that recommendations are not only aligned with stated preferences, but are also genuinely suitable and in the client's best long-term interests, thereby fulfilling regulatory obligations and ethical duties. Question 5. Consider a scenario where a client in South Africa, when asked about their risk tolerance, states they are not afraid of risk and are looking for high growth. However, a review of their financial statements reveals significant short-term debt and a limited emergency fund. What is the most appropriate approach for the financial advisor to take regarding risk assessment? Option A. Accept the client's self-assessment of not afraid of risk as the primary determinant for investment product selection, without further financial investigation. Option B. Prioritize recommending only low-risk, capital-guaranteed products due to the client's expressed concern about risk, despite their stated desire for high growth. Option C. Proceed with recommending aggressive, high-growth investment products as the client has explicitly stated they are not afraid of risk. Option D. Conduct a detailed analysis of the client's income, expenses, assets, liabilities, time horizon, and investment knowledge to determine their actual risk capacity, and then recommend suitable products. The correct answer is D. Conduct a detailed analysis of the client's income, expenses, assets, liabilities, time horizon, and investment knowledge to determine their actual risk capacity, and then recommend suitable products. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the financial advisor to balance the client's stated risk tolerance with the objective reality of their financial situation and the inherent risks associated with specific investment products. The advisor must avoid making assumptions based on superficial information and instead conduct a thorough, evidence-based assessment. The challenge lies in guiding the client towards a realistic understanding of their capacity for risk without alienating them or compromising their financial well-being. Correct approach analysis. The best approach involves a comprehensive risk assessment that goes beyond the client's self-declaration. This includes a detailed analysis of the client's financial situation, including income, expenses, assets, liabilities, and time horizon for the investment. It also necessitates understanding the client's knowledge and experience with investments. This multifaceted approach aligns with the principles of the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, which mandates that financial advisors act in the best interests of their clients and provide advice that is suitable, taking into account all relevant circumstances. A thorough assessment ensures that the advisor can accurately gauge the client's actual risk capacity, not just their stated tolerance, and recommend products that are appropriate and aligned with regulatory requirements for suitability. Incorrect approaches analysis. Relying solely on the client's stated risk tolerance without further investigation is professionally unacceptable. This approach fails to meet the FIS Act's requirement for a comprehensive assessment of the client's financial situation and capacity for risk. It risks recommending unsuitable products, potentially leading to significant financial losses for the client and regulatory breaches for the advisor. Recommending the most aggressive investment product available because the client expressed a desire for high returns, irrespective of their financial capacity or understanding, is also a failure. It prioritizes potential commission or a superficial interpretation of client desire over responsible advice and client protection, directly contravening the spirit and letter of the FIS Act suitability requirements. Suggesting only low-risk, capital-guaranteed products because the client expressed any level of concern about risk without exploring their actual capacity for loss or their financial goals is also problematic. While it errs on the side of caution, it may not be in the client's best interests if it unduly limits their potential for growth and fails to meet their long-term financial objectives, thereby not fulfilling the advisor's duty to provide appropriate advice. Professional reasoning. Financial advisors in South Africa must adopt a systematic and client-centric approach to risk assessment. This involves a structured process that begins with understanding the client's stated preferences, but critically moves to an objective evaluation of their financial circumstances, investment knowledge, and time horizons. The advisor should use a combination of client interviews, questionnaires, and financial data analysis to build a complete picture. This allows for the identification of any discrepancies between stated tolerance and actual capacity. The advisor's professional judgment is then applied to match suitable investment products to this comprehensive profile, ensuring compliance with the FIS Act and upholding ethical obligations to protect the client's financial interests. Question 6. During the evaluation of a new client's financial situation in South Africa, an advisor learns that the client is eager to achieve substantial returns within a short time frame to cover an immediate financial obligation. The client expresses a strong desire for high-growth potential investments, even if they carry significant risk. What is the most appropriate course of action for the financial advisor? Option A. Conduct a comprehensive risk assessment to understand the client's true risk tolerance, financial capacity, and investment objectives, and then recommend suitable investments that align with these findings, even if they do not meet the client's short-term return expectations. Option B. Proceed with recommending an investment that offers aggressive growth potential, assuming the client understands and accepts the associated risk due to their expressed eagerness for high returns. Option C. Advise the client on the potential for quick returns through speculative investments, without a detailed assessment of their overall financial situation or risk capacity. Option D. Recommend a high-risk, high-return investment product that the client has expressed interest in, as their stated desire for quick returns should be prioritized. The correct answer is A. Conduct a comprehensive risk assessment to understand the client's true risk tolerance, financial capacity, and investment objectives, and then recommend suitable investments that align with these findings, even if they do not meet the client's short-term return expectations. Explanation. This scenario is professionally challenging because it requires balancing the client's immediate financial needs with the fiduciary duty to protect their long-term interests, especially when dealing with a vulnerable client. The advisor must navigate potential conflicts of interest and ensure that any recommendations are suitable and aligned with the client's risk tolerance and objectives. As mandated by the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, the best approach involves a thorough and documented risk assessment that considers the client's current financial situation, investment objectives, and capacity to absorb losses. This assessment must be conducted in accordance with the FIS Act's General Code of Conduct, which emphasizes the need for financial advisors to act honestly, fairly, and with due skill, care, and diligence. Specifically, the advisor must gather sufficient information to understand the client's risk profile, including their knowledge of financial products, investment experience, and financial situation. Recommendations must then be based on this comprehensive understanding, ensuring that the proposed investment is appropriate for the client. This aligns with the FIS Act's requirement to provide advice that is suitable for the client. Recommending an investment solely based on the client's expressed desire for quick returns without a comprehensive risk assessment is professionally unacceptable. This approach fails to meet the FIS Act's requirements for suitability and could expose the client to undue risk, potentially leading to significant financial losses that they cannot afford. It prioritizes the client's immediate, potentially short-sighted, desire over their long-term financial well-being and the advisor's fiduciary duty. Suggesting an investment that offers high returns but is significantly outside the client's documented risk tolerance, even if the client verbally agrees, is also professionally unacceptable. This demonstrates a failure to adequately assess and manage risk, and a disregard for the client's capacity to handle potential losses. The FIS Act requires advisors to ensure that advice is appropriate, and this includes considering the client's ability to bear risk. Proceeding with an investment without obtaining explicit confirmation of the client's understanding of the associated risks, despite having conducted a risk assessment, is a failure in professional conduct. While a risk assessment is crucial, the FIS Act also mandates clear communication and ensuring the client comprehends the implications of their investment decisions. This omission can lead to misunderstandings and dissatisfaction, and potentially expose the advisor to liability. Professionals should employ a structured decision-making process that begins with a comprehensive client fact-finding exercise, including a detailed risk assessment. This information should then be used to identify suitable investment options that align with the client's objectives and risk profile. All recommendations must be clearly communicated, with associated risks explained in plain language and documented thoroughly. Regular reviews should be conducted to ensure ongoing suitability. Question 7. Research into client risk profiling in South Africa reveals a scenario where a client states a low tolerance for risk. However, the proposed investment product, while potentially offering higher returns, carries a significantly higher risk profile than typically associated with a low risk tolerance. What is the most appropriate course of action for the financial advisor? Option A. Override the client's stated low risk tolerance and recommend a more aggressive investment strategy that the advisor believes is better suited to achieve the client's financial goals. Option B. Engage in a detailed discussion with the client to explore the specifics of their risk tolerance, capacity for loss, and emotional response to market fluctuations, and clearly explain the investment's risks and how they align or misalign with the client's profile. Documenting this process thoroughly. Option C. Present the investment as a low-risk opportunity, downplaying its inherent risks to ensure the client feels comfortable proceeding with the recommendation. Option D. Proceed with the investment as requested by the client, assuming their stated low-risk tolerance is sufficient without further investigation, as their instruction is paramount. The correct answer is B. Engage in a detailed discussion with the client to explore the specifics of their risk tolerance, capacity for loss, and emotional response to market fluctuations, and clearly explain the investment's risks and how they align or misalign with the client's profile, documenting this process thoroughly. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the financial advisor to balance the client's stated risk tolerance with the advisor's professional duty to ensure the client understands and can withstand the actual risks involved in a proposed investment. The advisor must avoid simply accepting the client's self-assessment at face value, especially when the investment's risk profile significantly deviates from what might be expected for their stated tolerance. This requires careful judgment to prevent potential client harm and uphold regulatory standards. Correct approach analysis. The best professional practice involves a thorough, documented discussion with the client to explore the nuances of their risk tolerance. This includes understanding their capacity for loss, their emotional response to market volatility, and their investment objectives. The advisor should then clearly articulate the specific risks of the proposed investment, explaining how they align or misalign with the client's stated tolerance and capacity. This approach is correct because it directly addresses the requirements of the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, which mandates that financial advisors must act in the best interest of their clients. This includes conducting a proper needs analysis, which encompasses understanding the client's risk profile and providing advice that is suitable. Documenting this process is crucial for demonstrating compliance and protecting both the client and the advisor. Incorrect approaches analysis. One incorrect approach involves proceeding with the investment solely based on the client's initial statement of low risk tolerance, without further probing or explanation. This fails to meet the FIS Act's requirement for a comprehensive needs analysis and acting in the client's best interest. It risks placing the client in an investment they do not truly understand or can emotionally handle, leading to potential financial and emotional distress. Another incorrect approach is to dismiss the client's stated low risk tolerance and unilaterally decide on a more aggressive investment strategy that the advisor deems more suitable for their financial goals. This oversteps the advisor's authority and disregards the client's expressed preferences and comfort levels, violating the principle of client-centric advice mandated by the FIS Act. A further incorrect approach is to present the investment as a sure thing or downplay its inherent risks to secure the client's agreement. This constitutes misrepresentation and a failure to provide adequate disclosure, which is a serious breach of ethical conduct and regulatory obligations under the FIS Act. It undermines the client's ability to make an informed decision. Professional reasoning. Professionals should adopt a structured approach to risk assessment. This involves 1. Active listening and probing to fully understand the client's stated risk tolerance, capacity, and objectives. 2. Clearly and transparently explaining the risks and potential rewards of any proposed investment, using language the client can understand. 3. Documenting all discussions, assessments, and advice provided. 4. Ensuring that the final investment recommendation is demonstrably suitable for the client, considering all aspects of their profile and the investment's characteristics. This systematic process ensures compliance with regulatory requirements and promotes ethical client relationships. Question 8. In the context of providing financial advice in South Africa, the evaluation methodology shows that an advisor has completed a standardized risk tolerance questionnaire for a new client. What is the most appropriate next step to ensure compliance with the FIS Act and ethical best practices? Option A. Proceed with recommending investment products that align with the risk profile indicated by the questionnaire, assuming the client's responses are accurate and complete. Option B. Conduct a detailed discussion with the client to elaborate on the questionnaire responses, assess their financial situation, and confirm their investment objectives, documenting all findings. Option C. Present the client with a range of investment options that appear suitable based on the questionnaire, allowing the client to make the final decision with minimal further guidance. Option D. Focus the subsequent advice on investment products with the highest potential returns, as this is generally what clients are seeking, regardless of the questionnaires' risk assessment. The correct answer is B. Conduct a detailed discussion with the client to elaborate on the questionnaire responses, assess their financial situation, and confirm their investment objectives, documenting all findings. Explanation. The evaluation methodology shows a critical juncture in financial advisory practice in South Africa, specifically concerning the application of the Financial Advisory and Intermediary Services Act, FIS Act, and its associated General Code of Conduct. The scenario presents a challenge because it requires the advisor to balance client needs with regulatory obligations, particularly when dealing with potentially complex or high-risk investment products. The advisor must exercise professional judgment to ensure that the risk assessment is not merely a procedural step, but a substantive part of the advice process, leading to suitable recommendations. The correct approach involves a comprehensive and documented assessment of the client's risk tolerance, financial situation, and investment objectives. This methodology ensures that the advisor has a thorough understanding of the client's profile, which is a fundamental requirement under the FIS Act for providing advice that is appropriate and in the client's best interest. By considering all these factors and documenting them, the advisor creates a clear audit trail demonstrating compliance with the duty of care and the obligation to provide suitable advice. This aligns with the principles of treating customers fairly and upholding professional integrity. An incorrect approach would be to rely solely on a standardized questionnaire without further discussion or verification. This fails to capture the nuances of a client's situation and may lead to an inaccurate assessment of their risk tolerance. Ethically and regulatorily, this approach bypasses the advisor's duty to gain a deep understanding of the client, potentially resulting in unsuitable recommendations and a breach of the FIS Act's requirements for suitability. Another incorrect approach is to prioritize the sale of a specific product over the client's actual needs and risk profile. This demonstrates a conflict of interest and a failure to act in the client's best interest, which is a core ethical and regulatory principle. Such an approach would likely contravene the FIS Act's provisions on conduct of business and could lead to significant reputational damage and regulatory sanctions. Finally, an approach that focuses only on the potential returns of an investment without adequately exploring the associated risks is also flawed. The FIS Act mandates a balanced consideration of both risk and return. Failing to adequately assess and communicate the risks involved, especially in relation to the client's tolerance, is a direct contravention of the advisor's duty to provide informed advice and could expose the client to unacceptable levels of risk. Professionals should adopt a decision-making process that begins with a thorough understanding of the client's circumstances, followed by a detailed risk assessment that informs the subsequent recommendation. This process should be iterative, allowing for clarification and adjustment based on client feedback. Documentation is crucial at every stage to demonstrate compliance and to protect both the client and the advisor. Question 9. The evaluation methodology shows that a South African financial advisor is assessing the risk profile of a new client, MS. Themba, who expresses a strong desire for investment growth, but also a significant aversion to any capital loss. Which of the following approaches best reflects the professional and regulatory requirements for conducting this risk assessment? Option A. Dismiss MS. Themba's aversion to loss as a sign of financial illiteracy and proceed with a growth-oriented investment strategy without further probing her concerns. Option B. Engage in a detailed discussion with MS. Themba to explore the qualitative aspects of her risk tolerance and conduct a quantitative assessment of her capacity to absorb risk, considering her financial situation and investment objectives to form a holistic understanding. Option C. Solely administer a standardized risk profiling questionnaire and proceed with investment recommendations based on the resulting score, assuming it accurately reflects her risk appetite. Option D. Prioritize MS. Themba's stated desire for growth and recommend a portfolio with a high allocation to growth assets, downplaying her concerns about potential capital loss. Correct answer is B. Engage in a detailed discussion with MS. Themba to explore the qualitative aspects of her risk tolerance and conduct a quantitative assessment of her capacity to absorb risk, considering her financial situation and investment objectives to form a holistic understanding. Explanation. The evaluation methodology shows that a financial advisor in South Africa is tasked with assessing the risk profile of a new client, MS. Themba, who is seeking investment advice. This scenario is professionally challenging because accurately gauging a client's risk tolerance is foundational to providing suitable financial advice, directly impacting the client's financial well-being and the advisor's compliance with regulatory obligations. MS. Themba has expressed a desire for growth, but also indicated a strong aversion to any potential loss of capital, creating a potential conflict between her stated objectives and her risk capacity. The correct approach involves a comprehensive and multifaceted risk assessment that goes beyond a single questionnaire. This includes a detailed discussion with MS. Themba to understand the qualitative aspects of her risk tolerance, such as her emotional response to market volatility, her financial knowledge, and her past investment experiences. It also requires a quantitative assessment of her capacity to absorb risk, considering her income, expenses, existing assets, liabilities, and time horizon for her investments. This holistic methodology aligns with the principles of the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, which mandates that financial advisors must act in the client's best interest and provide advice that is suitable based on a thorough understanding of the client's financial situation, needs, and objectives. The FIS Act, through its General Code of Conduct, requires advisors to gather sufficient information to make an informed recommendation. An incorrect approach would be to solely rely on a standardized risk profiling questionnaire, especially when the client's responses present conflicting signals. This approach fails to capture the nuances of MBA's risk perception and capacity, potentially leading to advice that is either too conservative to meet her growth objectives or too aggressive given her stated aversion to loss. Ethically and regulatorily, this is a failure to conduct adequate due diligence. Another incorrect approach would be to prioritize MBA's stated desire for growth above her expressed fear of capital loss, without thoroughly exploring the implications of this imbalance. This could lead to recommending investments that expose her to unacceptable levels of risk, violating the principle of suitability and the duty to act in her best interest as stipulated by the FIS Act. A third incorrect approach would be to dismiss MBA's aversion to loss as simply a lack of understanding and proceed with a high-growth strategy without addressing her concerns. This demonstrates a lack of empathy and a failure to engage in a meaningful dialogue, which is crucial for building trust and ensuring the client understands and accepts the risks associated with their investment choices. Professionals should adopt a structured decision-making process that begins with active listening and open-ended questioning to uncover the client's true needs and concerns. This should be followed by a systematic gathering of both qualitative and quantitative information, using appropriate tools and techniques. Crucially, the advisor must then synthesize this information to form a clear picture of the client's risk profile, identifying any discrepancies or conflicts that need further clarification. The final step involves presenting a clear rationale for the recommended investment strategy, ensuring the client understands the associated risks and rewards and feels comfortable with the proposed course of action. Question 10. Quality control measures reveal that a client's investment portfolio in South Africa needs to be valued as at the close of business on Friday, 15th March 2024. However, Friday, 15th March 2024 is a public holiday and the stock exchange is closed. The portfolio contains a mix of listed securities and unlisted instruments. Which of the following methods for valuing the portfolio would be considered the most professionally sound and compliant with South African financial advisory regulations? Option A. Use the closing prices of the listed securities from Thursday, 14th March 2024, and estimate the value of the unlisted instruments based on general market trends observed over the past week. Option B. Use the opening prices of the listed securities on Monday, 18th March 2024, and the latest available valuation for the unlisted instruments. Option C. Use the closing prices of the listed securities from Thursday, 14th March 2024, and a valuation for the unlisted instruments that was performed 6 months ago. Option D. Use the closing prices of the listed securities from Thursday, 14th March 2024, and the latest available valuation for the unlisted instruments. The correct answer is D. Use the closing prices of the listed securities from Thursday, 14th March 2024, and the latest available valuation for the unlisted instruments. Explanation. This scenario presents a professional challenge due to the need to accurately calculate and report the value of a client's investment portfolio, which directly impacts compliance with regulatory reporting requirements and the client's understanding of their financial position. The Financial Advisory and Intermediary Services Act, FIS Act, in South Africa mandates that financial advisors act with honesty, integrity, and fairness, and provide clients with accurate and understandable information. Misrepresenting the value of an investment portfolio, even unintentionally, can lead to breaches of these duties and potential reputational damage. The correct approach involves using the most recent available closing prices for all listed securities and the latest valuation for unlisted instruments, ensuring a true and fair reflection of the portfolio's value as at the reporting date. This aligns with the FIS Act's requirement for accurate disclosure and the general ethical obligation to provide clients with reliable information. Specifically, the General Code of Conduct for Financial Services Providers and Representatives under the FIS Act emphasizes the importance of providing clients with clear, correct, and comprehensive information. Using the closing price on the reporting date is the industry standard for valuation and ensures consistency and comparability. An incorrect approach would be to use the previous day's closing prices for listed securities if the reporting date is a public holiday and the market is closed. This fails to provide the most up-to-date valuation and misrepresents the current market value of the assets. Ethically and regulatorily, this is unacceptable as it deviates from the principle of providing current and accurate information. Another incorrect approach would be to estimate the value of unlisted instruments based on a general market trend, rather than obtaining the latest available specific valuation. This introduces an unnecessary layer of subjectivity and potential inaccuracy, violating the duty to provide a fair and true representation. Finally, using the opening price of the reporting date for listed securities, if the market is open, is also incorrect because it does not reflect the full trading day's activity, and the final closing price is the universally accepted benchmark for valuation at the end of a trading period. Professionals should adopt a decision-making process that prioritizes accuracy and regulatory compliance. This involves understanding the specific reporting requirements, identifying the relevant valuation dates and methodologies for different asset classes, and ensuring that all data used is the most current and reliable available. In situations where market closures occur, the professional must seek the most recent available data that accurately reflects the asset's value at the closest possible point in time to the reporting date, while clearly disclosing any valuation limitations. Question 11. Compliance review shows that a financial advisor in South Africa has recommended a complex, illiquid investment product to a client who has expressed a desire for high returns. The client has stated, "I understand it's a bit risky, but I want to make a lot of money." The advisor has not yet confirmed the client's specific understanding of the product's illiquidity or the potential for total capital loss, which approach best upholds the advisor's professional and regulatory obligations under the Financial Advisory and Intermediary Services Act, FIS Act. Option A. Immediately suggest the client seek independent financial advice without further explanation from the advisor. Option B. Proceed with the recommendation as the client has indicated they understand and desire high returns. Option C. Proactively verify the client's comprehension of the investment's risks and benefits, particularly its illiquid nature and potential for capital loss, before proceeding with the recommendation. Option D. Focus the discussion solely on the potential for high returns, downplaying the risks to align with the client's stated objective. The correct answer is C. Proactively verify the client's comprehension of the investment's risks and benefits, particularly its illiquid nature and potential for capital loss, before proceeding with the recommendation. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing client needs with regulatory obligations. The financial advisor must navigate the potential for a client to misunderstand or misinterpret complex investment products, which could lead to unsuitable recommendations and potential harm. The challenge lies in ensuring the client's understanding is robust enough to make informed decisions, without being patronizing or overly restrictive, all while adhering to the strict disclosure and suitability requirements of the Financial Advisory and Intermediary Services Act, FIS Act. In South Africa, correct approach analysis. The best professional practice involves proactively verifying the client's comprehension of the investment's risks and benefits, particularly its illiquid nature and potential for capital loss, before proceeding with the recommendation. This approach directly aligns with the FIS Act's core principles of acting honestly, fairly, and with due skill, care, and diligence. Specifically, Section 7 of the FIS Act mandates that financial advisors must take reasonable steps to ensure that clients understand the nature and risks of financial products before making a recommendation. By confirming the client's grasp of the illiquidity and potential for loss, the advisor is fulfilling this duty of care and ensuring the recommendation is suitable, thereby mitigating the risk of misrepresentation or advice that is not in the client's best interest. Incorrect approach is analysis, recommending the product immediately after the client states they understand, without further probing, fails to adequately assess the depth of their comprehension. This approach risks a superficial understanding on the client's part, potentially leading to a recommendation that is not truly suitable, violating the FIS Act's requirement for reasonable steps to ensure understanding and suitability, suggesting the client seek independent financial advice without first attempting to explain the product in simpler terms or assess their understanding. While a valid option in some contexts, can be seen as an abdication of the advisor's primary responsibility under the FIS Act to provide clear and understandable information. It may also be perceived as an unnecessary barrier to the client's investment goals if the advisor could have effectively clarified the product themselves. Focusing solely on the client's stated desire for high returns, without adequately addressing the associated risks and the product's illiquid nature, directly contravenes the FIS Act's emphasis on suitability. This approach prioritizes the client's stated preference over a holistic assessment of their needs and risk tolerance, potentially leading to a recommendation that is detrimental to the client's financial well-being. Professional reasoning. Professionals should adopt a client-centric approach that prioritizes clear communication and thorough understanding. This involves a structured process. First, understanding the client's objectives and risk appetite. Second, explaining the proposed financial product in clear, jargon-free language, highlighting both potential benefits and significant risks, including any illiquidity or capital loss potential. Third, actively probing the client's understanding through open-ended questions and seeking confirmation. And finally, documenting the entire process, including the client's comprehension and the rationale for the recommendation, to demonstrate compliance with regulatory requirements and ethical obligations. Question 12. Which approach would be most appropriate for a licensed financial advisor in South Africa when they observe a significant negative market trend that is likely to impact a client's existing investment portfolio, and the next scheduled review is still several weeks away? Option A. Wait until the next scheduled review meeting to discuss the market trend and its impact, to avoid causing unnecessary alarm. Option B. Inform the client that the market is experiencing some volatility, but assure them that such fluctuations are normal and will likely correct themselves. Option C. Advise the client to disinvest from all assets immediately due to the perceived risk, without a thorough assessment of their individual circumstances. Option D. Immediately contact the client to explain the market trend, its potential impact on their portfolio, and propose adjustments aligned with their risk profile and financial goals. Correct answer is D. Immediately contact the client to explain the market trend, its potential impact on their portfolio, and propose adjustments aligned with their risk profile and financial goals. Explanation. This scenario presents a professional challenge because it requires balancing client needs with regulatory obligations, specifically concerning the disclosure of material information that could impact investment decisions. The advisor must act in the client's best interest while adhering to the Financial Advisory and Intermediary Services Act, FIS Act, and the General Code of Conduct for Financial Services Providers and Representatives. The best approach involves proactively informing the client about the potential negative impact of the market trend on their existing portfolio and recommending a course of action that aligns with their risk profile and financial goals. This demonstrates a commitment to the client's well-being and fulfills the advisor's fiduciary duty. Specifically, the FIS Act mandates that financial services providers must provide advice and render services honestly, fairly, and with due skill, care, and diligence. The General Code of Conduct further requires representatives to disclose all material information that might reasonably be expected to influence the client's decision. By presenting the information and proposing adjustments, the advisor upholds these principles, ensuring transparency and informed consent. An approach that delays informing the client until the next scheduled meeting is professionally unacceptable. This failure to disclose material information promptly violates the FIS Act's requirement for honest and fair dealing. It also breaches the General Code of Conduct by withholding information that could influence the client's investment strategy, potentially leading to significant losses and eroding trust. Another professionally unacceptable approach is to downplay the significance of the market trend to avoid causing the client undue concern. This misrepresents the situation and fails to provide the client with the necessary information to make informed decisions, thereby violating the duty of care and skill. Finally, an approach that focuses solely on the potential for future recovery without acknowledging the current negative impact and its implications for the client's immediate financial situation is also flawed. This selective disclosure is not in the client's best interest and fails to meet the regulatory standard of providing comprehensive and balanced advice. Professionals should adopt a decision-making framework that prioritizes client interests and regulatory compliance. This involves continuous monitoring of market conditions, proactive communication of material information, and providing clear, actionable recommendations that are tailored to the client's specific circumstances and risk tolerance. Transparency and ethical conduct are paramount in maintaining client trust and fulfilling professional responsibilities. Question 13. Investigation of a client's request in Gauteng, South Africa, to invest in a specific unit trust fund that the financial advisor believes is not the most suitable option given the client's stated risk profile and long-term financial goals, presents an implementation challenge. The client is insistent on this particular fund due to a recommendation from a friend. What is the most appropriate course of action for the financial advisor to take? In accordance with the Financial Advisory and Intermediary Services Act, FIS Act, and its General Code of Conduct. Option A. Focus on highlighting the specific features of the requested unit trust fund that the client finds appealing, without conducting a full needs analysis or discussing alternative, more suitable options. Option B. Politely decline the client's request and inform them that the advisor cannot recommend the fund, without further explanation or exploring alternatives. Option C. Engage in a detailed discussion with the client to understand the rationale behind their preference. Explain the advisor's professional assessment of the fund's suitability based on their financial needs and objectives, and document the entire process, including the client's final informed decision. Option D. Immediately proceed with the client's request to invest in the specified unit trust fund to ensure client satisfaction, as the client is the ultimate decision maker. The correct answer is C. Engage in a detailed discussion with the client to understand the rationale behind their preference. Explain the advisor's professional assessment of the fund's suitability based on their financial needs and objectives, and document the entire process, including the client's final informed decision. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's expressed wishes and the advisor's fiduciary duty to act in the client's best interest, particularly when those wishes might lead to suboptimal financial outcomes or regulatory noncompliance. The advisor must navigate this delicate balance while adhering to the Financial Advisory and Intermediary Services Act, FIS Act, and its associated General Code of Conduct in South Africa. Careful judgment is required to ensure client satisfaction without compromising professional integrity or legal obligations. The best approach involves a thorough, documented discussion with the client to understand the underlying reasons for their request, followed by a clear explanation of the regulatory implications and the advisor's professional recommendations based on the client's financial needs and objectives as determined by the FIS Act's requirements for suitability. This approach prioritizes client education and informed consent, ensuring that any decision made is in the client's best interest and aligns with regulatory expectations for advice and product recommendations. The FIS Act mandates that financial advisors must provide advice that is appropriate to the client's circumstances, and this involves understanding their needs, objectives, financial situation, and risk tolerance. Documenting this process is crucial for demonstrating compliance. An approach that immediately proceeds with the client's request without further inquiry or explanation fails to uphold the advisor's duty to provide suitable advice as mandated by the FIS Act. It risks recommending a product that is not in the client's best interest, potentially exposing both the client and the advisor to future complications and regulatory scrutiny. Another incorrect approach involves dismissing the client's request outright without attempting to understand their motivations or providing alternative compliance solutions. This can lead to client dissatisfaction and a breakdown in the professional relationship, while also failing to meet the FIS Act's requirement to engage with the client to determine their needs and objectives. Finally, an approach that focuses solely on the product features the client desires, without adequately assessing the client's overall financial situation and suitability for that product, also violates the FIS Act. The advisor's responsibility extends beyond simply fulfilling a product preference. It requires a holistic assessment to ensure the advice given is appropriate and in the client's long-term best interest. Professionals should employ a decision-making framework that begins with active listening to understand the client's request and underlying rationale. This should be followed by a comprehensive needs analysis, a clear explanation of regulatory requirements and product suitability, the presentation of compliant recommendations, and thorough documentation of the entire process. This ensures that client autonomy is respected within the bounds of professional responsibility and regulatory compliance. Question 14. Assessment of an intermediary's implementation challenge in South Africa. A client, Mr. Botha, has expressed a strong desire to invest in a specific complex structured product he read about. He is insistent on proceeding immediately. The intermediary has not yet conducted a full suitability assessment for Mr. Botha regarding this particular product. What is the most appropriate course of action for the intermediary? Option A. Conduct a comprehensive suitability assessment for Mr. Botha, considering his financial situation, investment objectives, and risk tolerance before proceeding with the implementation of the structured product. Option B. Recommend a different, simpler investment product to Mr. Botha that is easier to understand, without fully exploring his interest in the structured product. Option C. Implement the structured product immediately as requested by Mr. Botha to ensure client satisfaction and avoid losing the opportunity. Option D. Proceed with the implementation of the structured product based solely on Mr. Botha's expressed interest, assuming he understands the risks involved. The correct answer is A. Conduct a comprehensive suitability assessment for Mr. Botha, considering his financial situation, investment objectives, and risk tolerance before proceeding with the implementation of the structured product. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an intermediary to balance the client's immediate desire for a specific investment with the intermediary's fiduciary duty to ensure the investment is suitable and aligns with the client's financial objectives and risk tolerance. The challenge lies in navigating potential conflicts between client persuasion and regulatory obligations, particularly concerning the implementation of a complex financial product. Correct approach analysis. The best professional practice involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance before recommending or implementing any investment. This includes understanding the specific nature of the structured product, its underlying assets, associated risks, and how it fits within the client's overall portfolio. This approach is correct because it directly aligns with the principles of client-centric advice and the regulatory requirements in South Africa, such as those mandated by the Financial Advisory and Intermediary Services Act, FIS Act, which emphasizes the need for intermediaries to act honestly, fairly, and with due skill, care, and diligence in providing financial advice and intermediary services. Implementing a product without this foundational understanding would be a breach of these duties. Incorrect approaches analysis. Recommending the product solely based on the client's expressed interest without conducting a suitability assessment fails to uphold the intermediary's fiduciary duty and contravenes the FIS Act's requirement for advice to be appropriate to the client's circumstances. Implementing the product immediately to satisfy the client's request without understanding its intricacies or the client's capacity to absorb potential losses prioritizes client satisfaction over client well-being and regulatory compliance. Suggesting a different, simpler product without fully exploring the client's stated interest in the structured product, and without a clear justification based on suitability, may also be problematic as it bypasses the client's expressed preference without proper due diligence. Professional reasoning. Professionals should adopt a systematic approach to client engagements. This involves an initial discovery phase to gather comprehensive client information, followed by a detailed analysis of potential financial products against the client's profile. Any recommendation or implementation must be justifiable based on suitability and regulatory requirements. When faced with client pressure, professionals must remain steadfast in their adherence to ethical and legal obligations, communicating clearly with the client about the rationale behind their professional judgment. Question 15. Quality control measures reveal that a financial services provider in South Africa is experiencing a significant drop-off rate during its online client onboarding process. To address this, management is considering streamlining the digital application by reducing the number of questions related to financial situation, investment objectives, and risk tolerance, with the intention of gathering this information more thoroughly through a subsequent phone call. What is the most appropriate approach to ensure compliance with the Financial Advisory and Intermediary Services Act, FIS Act, and its General Code of Conduct while improving the onboarding experience? Option A. Significantly reduce the number of mandatory questions in the online application concerning financial situation, investment objectives, and risk tolerance, deferring detailed assessment to a later, less structured manual process. Option B. Bypass detailed risk assessment for clients who express a strong preference for rapid onboarding, assuming their stated desire for speed supersedes the need for a comprehensive suitability assessment. Option C. Implement an overly complex and unguided series of questions in the online platform, accepting all client input without robust validation, and proceeding with onboarding based on this potentially unreliable information. Option D. Integrate comprehensive client information gathering and suitability assessment questions directly into the digital onboarding platform, with built-in validation and clear explanations of risk profiles, requiring client acknowledgement before proceeding. The correct answer is D. Integrate comprehensive client information gathering and suitability assessment questions directly into the digital onboarding platform, with built-in validation and clear explanations of risk profiles, requiring client acknowledgement before proceeding. Explanation. Scenario analysis. This scenario presents a common implementation challenge where a firm must balance the need for efficient client onboarding with the stringent requirements of the Financial Advisory and Intermediary Services Act, FIS Act, and its associated General Code of Conduct. The challenge lies in ensuring that all necessary client information is gathered and verified, without creating undue delays that could deter potential clients or lead to lost business, while simultaneously adhering to the spirit and letter of the law regarding client suitability and risk profiling. Correct approach analysis. The best approach involves integrating the FIS Act's requirements for client information gathering and suitability assessments directly into the digital onboarding process. This means designing the online platform to prompt clients for all mandatory information, including their financial situation, investment objectives, risk tolerance, and knowledge and experience in financial products. The system should be programmed to validate the completeness and plausibility of the provided information, flagging any gaps or inconsistencies for immediate attention. Furthermore, the platform should incorporate a clear, understandable explanation of the client's risk profile based on their input, and require explicit client acknowledgement before proceeding. This approach ensures compliance by embedding regulatory requirements into the operational workflow, thereby minimizing the risk of non-compliance and safeguarding the client's interests. It directly addresses the FIS Act's mandate for intermediaries to act honestly, fairly, and with due skill, care, and diligence in rendering financial advice and intermediary services. Incorrect approaches analysis. One incorrect approach is to rely solely on a simplified online questionnaire that captures only basic contact details and a broad investment preference, deferring detailed risk assessment and suitability checks to a later, less structured manual process. This fails to meet the FIS Act's requirement for a comprehensive understanding of the client's financial situation and investment objectives at the point of engagement. It creates a significant risk of recommending unsuitable products, which is a direct contravention of the General Code of Conduct. Another incorrect approach is to present a lengthy, complex, and unguided series of questions that overwhelm the client, leading to rushed or inaccurate responses, and then proceeding with onboarding without adequate verification of the provided information. While it attempts to gather information, the lack of guidance and validation means the information gathered may not be reliable or sufficient for a proper suitability assessment, again risking the recommendation of inappropriate products. This approach also fails to demonstrate due skill, care, and diligence. A third incorrect approach is to bypass the detailed risk assessment entirely for clients who express a desire for a quick onboarding process, assuming their stated preference overrides the need for a thorough suitability assessment. This is a critical failure to comply with the FIS Act, which mandates that intermediaries must take all reasonable steps to ensure that any recommendation made is appropriate to the client's circumstances, regardless of the client's perceived urgency. The client's desire for speed cannot absolve the intermediary of their regulatory obligations. Professional reasoning. Professionals should adopt a client-centric yet compliance-driven mindset. The decision-making process should prioritize understanding and embedding regulatory requirements into the core business processes. This involves a proactive approach to compliance, where the firm designs its systems and procedures to inherently support regulatory adherence. When faced with implementation challenges, the professional should always ask, does this process ensure we are acting honestly, fairly, and with due skill, care, and diligence as required by the FIS Act? And does this process adequately assess client suitability before any recommendation is made? The goal is to create efficient processes that do not compromise regulatory integrity or client protection. Question 16. Risk assessment procedures indicate that a client in South Africa who has verbally expressed a moderate risk tolerance is now requesting to invest a significant portion of their portfolio in a highly volatile emerging market equity fund. What is the most appropriate course of action for the financial advisor? Option A. Proceed with the investment as requested, as the client has verbally confirmed their risk tolerance and expressed a desire for this specific investment. Option B. Invest in the high volatility fund and simply document that the client verbally agreed to the investment without further clarification of risks. Option C. Conduct a detailed discussion with the client to explain the specific risks and potential downsides of the high volatility fund, ensuring they understand its characteristics and how it aligns with their overall financial goals, and obtain informed consent. Option D. Refuse to recommend the high volatility fund and insist on a more conservative investment option that the advisor deems more suitable for the client's stated risk tolerance. Correct answer is C. Conduct a detailed discussion with the client to explain the specific risks and potential downsides of the high volatility fund, ensuring they understand its characteristics and how it aligns with their overall financial goals, and obtain informed consent. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires the financial advisor to balance the client's stated risk tolerance with the advisor's professional duty to ensure the client understands the true nature and potential consequences of their investment choices. The challenge lies in navigating the client's potential overconfidence or lack of full comprehension regarding the volatility of the proposed investment, while still respecting their autonomy. Careful judgment is required to avoid both unduly influencing the client and failing in the duty of care. Correct approach analysis. The best professional practice involves a thorough and documented discussion with the client about the specific risks associated with the proposed high-volatility investment. This includes clearly explaining the potential for significant capital loss, the investment's historical performance in various market conditions, and how it aligns, or misaligns, with their stated long-term financial goals and overall risk profile. The advisor must ensure the client comprehends these risks and provides informed consent, ideally in writing, acknowledging their understanding. This approach aligns with the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, which mandates that financial advisors act in the best interests of their clients, provide advice that is appropriate to the client's circumstances, and ensure clients understand the products being recommended. The FIS Act emphasizes the importance of disclosure and suitability. Incorrect approach is analysis. One incorrect approach involves proceeding with the investment solely based on the client's initial verbal confirmation of risk tolerance without further probing or detailed explanation. This fails to meet the FIS Act's requirement for suitability and adequate disclosure. The advisor has not taken reasonable steps to ensure the client truly understands the implications of investing in a high-volatility product, potentially exposing them to unacceptable risk and breaching the duty of care. Another incorrect approach is to dismiss the client's stated risk tolerance and refuse to recommend the investment, instead pushing a more conservative option. While the advisor may believe it is in the client's best interest, this approach oversteps the advisor's role by not respecting the client's ultimate decision-making authority after being fully informed. The FIS Act requires advice to be appropriate, but it does not grant the advisor the power to unilaterally override a client's informed choices, provided those choices are not demonstrably reckless or illegal. A third incorrect approach is to proceed with the investment and simply document that the client verbally agreed, without any further discussion or clarification of the specific risks. This creates a false sense of compliance. The FIS Act requires more than a perfunctory verbal agreement. It necessitates a demonstrable understanding by the client of the risks involved, especially for products with inherent high volatility. This approach risks being seen as a failure to adequately advise and protect the client. Professional reasoning. Professionals should adopt a structured approach to client interactions, particularly when dealing with complex or high-risk investments. This involves 1. Active listening to understand the client's stated needs and risk tolerance. 2. Probing questions to uncover underlying assumptions or potential misunderstandings. 3. Clear, jargon-free explanations of product features, benefits, and crucially risks. 4. Documenting the advice provided and the client's understanding and consent. 5. Reassessing suitability periodically. In this specific scenario, the advisor must prioritize informed consent and robust disclosure, ensuring the client's decision is based on a comprehensive understanding of the potential downsides, not just the perceived upsides. Question 17. Quality control measures reveal that a financial advisor in Gauteng, South Africa, has not yet scheduled any continuing professional development (CPD) activities for the upcoming compliance year, despite the deadline being several months away. The advisor's primary role involves providing advice on long-term insurance and investment products. What is the most appropriate course of action to ensure compliance with the Financial Sector Conduct Authority's requirements? Option A. Rely on informal learning and discussions with colleagues about market trends to fulfill the CPD requirements, as formal training is not always necessary. Option B. Immediately identify and book accredited CPD courses that are directly relevant to long-term insurance and investment products, and align with the advisor's specific duties in the South African market, ensuring completion before the compliance deadline. Option C. Choose a broad range of general business management CPD courses that are easily accessible, even if they are not directly related to financial advisory services in South Africa. Option D. Wait until the final month before the compliance deadline to select and complete any available CPD courses to minimize disruption to client meetings. The correct answer is B. Immediately identify and book accredited CPD courses that are directly relevant to long-term insurance and investment products, and align with the advisor's specific duties in the South African market, ensuring completion before the compliance deadline. Explanation. Scenario analysis. This scenario presents a common implementation challenge in financial advisory services in South Africa, specifically concerning the ongoing professional development requirements for representatives. The challenge lies in balancing the need for continuous learning with the practical constraints of time and resources, while ensuring compliance with the Financial Sector Conduct Authority (FSCA) regulations. Failure to adhere to these requirements can lead to regulatory sanctions and reputational damage. Correct approach analysis. The best professional practice involves proactively identifying and scheduling relevant training that directly addresses the representative's role and the evolving regulatory landscape in South Africa. This approach ensures that the representative not only meets the minimum compliance requirements, but also enhances their ability to provide competent advice. The FSCA regulations, particularly those pertaining to fit and proper requirements, mandate ongoing professional development to maintain competence. By selecting training that aligns with the representative's specific duties and the South African financial services environment, the representative demonstrates a commitment to both regulatory compliance and client service excellence. This proactive and targeted approach is crucial for demonstrating ongoing competence, as required by the Financial Advisory and Intermediary Services Act, FIS Act. Incorrect approaches analysis. One incorrect approach involves delaying the identification and completion of training until the end of the compliance period. This creates a significant risk of non-compliance due to unforeseen scheduling conflicts or the unavailability of suitable training. It also suggests a reactive rather than proactive approach to professional development, which is contrary to the spirit of the FSCA ongoing competence requirements. Another incorrect approach is to choose training that is not relevant to the representative's specific role or the South African financial services market. While it might technically fulfill a training hour requirement, it fails to enhance the representative's actual competence in advising clients within the South African context. This undermines the purpose of ongoing professional development as mandated by the FSCA, which aims to ensure representatives are equipped to provide sound financial advice. A third incorrect approach is to rely solely on informal learning or on-the-job experience without structured, accredited training. While experience is valuable, the FSCA regulations typically require formal, verifiable professional development activities to demonstrate ongoing competence. Informal learning, while beneficial, may not always meet the specific criteria for CPD, continuing professional development, as defined by regulatory bodies in South Africa. Professional reasoning. Professionals should adopt a structured and proactive approach to managing their ongoing professional development. This involves understanding the specific CPD requirements applicable in South Africa, such as those set by the FSCA for representatives. It is essential to create a personal development plan that identifies relevant training opportunities throughout the compliance period, rather than leaving it to the last minute. Regular review of the plan and the chosen training's relevance to one's role and the South African market is critical. Furthermore, maintaining accurate records of completed CPD activities is a fundamental aspect of demonstrating compliance. Question 18. The audit findings indicate that a financial planning firm in South Africa, while experiencing pressure to meet new product sales targets, has been observed recommending a new investment product to several clients. These recommendations appear to be based on the product's attractive commission structure rather than a detailed, client-specific analysis of their individual financial circumstances and risk profiles. What is the most appropriate course of action for the financial planner in this situation? Option A. Proceed with recommending the new product to clients who appear to be a good fit, as the firm is under pressure to meet sales targets and the product is generally considered a sound investment. Option B. Conduct a comprehensive, documented assessment of each client's financial situation, needs, objectives, and risk tolerance, and only recommend the new product if it is demonstrably suitable and in their best interest, irrespective of commission. Option C. Inform clients about the new product's attractive commission structure and allow them to decide if they wish to invest, thereby shifting the decision-making responsibility to the client. Option D. Focus on clients who have previously expressed interest in similar investments and recommend the new product, assuming it aligns with their general investment preferences without a detailed reassessment. The correct answer is B. Conduct a comprehensive, documented assessment of each client's financial situation, needs, objectives, and risk tolerance, and only recommend the new product if it is demonstrably suitable and in their best interest, irrespective of commission. Explanation. The audit findings indicate a potential breakdown in the firm's adherence to the Financial Advisory and Intermediary Services Act, FIS Act, and its associated General Code of Conduct, specifically concerning the duty to act in the client's best interest and to provide advice that is appropriate. The professional challenge lies in balancing the firm's commercial objectives with its fiduciary duties to clients, especially when faced with pressure to meet sales targets or promote specific products. Careful judgment is required to ensure that client needs and suitability remain paramount, even when alternative, potentially more profitable, options exist. The correct approach involves a thorough and documented assessment of the client's financial situation, needs, objectives, and risk tolerance. This assessment must be comprehensive, going beyond superficial questioning to truly understand the client's circumstances. Based on this detailed understanding, the financial planner must then identify and recommend financial products or services that are demonstrably suitable and in the client's best interest, even if they are not the highest commission-generating options. The FIS Act mandates that advice must be appropriate, and the General Code of Conduct emphasizes the duty to act honestly, fairly, and with due skill, care, and diligence. This approach ensures compliance by prioritizing client welfare and providing a robust, auditable trail of the decision-making process. An incorrect approach would be to prioritize the promotion of a new, high-commission product simply because it is being heavily incentivized by the product provider, without a thorough suitability assessment. This directly contravenes the FIS Act's requirement for appropriate advice and the client's best interest. Another incorrect approach is to rely solely on a standardized questionnaire that does not adequately probe the nuances of the client's financial situation or risk appetite, leading to potentially unsuitable recommendations. This demonstrates a lack of due skill, care, and diligence. Finally, recommending a product based on the planner's personal preference or past success with similar clients, without a fresh, client-specific suitability assessment, is also professionally unacceptable and a breach of regulatory obligations. Professionals should employ a decision-making framework that begins with a clear understanding of their fiduciary duties under the FIS Act. This involves always putting the client's interests first, conducting thorough and documented needs analyses, and rigorously evaluating product suitability against those identified needs and the client's risk profile. When faced with competing interests, e.g., firm profitability vs. client best interest, the regulatory framework clearly dictates that the client's interests must prevail. Regular training and internal controls that reinforce these principles are crucial for maintaining professional standards. Question 19. Quality control measures reveal that a financial advisor in South Africa has been handling a series of complex transactions for a client that, while not explicitly illegal on their face, exhibits several unusual patterns and a lack of clear economic purpose. The advisor has a general feeling that something is not quite right, but has not conducted a formal assessment against FICA indicators of suspicious transactions. What is the most appropriate course of action for the advisor? Option A. Conduct a thorough internal assessment of the transactions against the indicators of suspicious transactions as defined by the Financial Intelligence Center Act (FICA), and if reasonable suspicion is formed, file a suspicious transaction report (STR) with the Financial Intelligence Center. Option B. Immediately report the transactions to the Financial Intelligence Center without further investigation. Based on the advisor's general feeling of unease. Option C. Discuss the advisor's suspicions with the client to understand the rationale behind the unusual transaction patterns before deciding on any further action. Option D. Continue to process the transactions as usual, as there is no definitive proof of illegal activity, and avoid raising any concerns to maintain the client relationship. The correct answer is A. Conduct a thorough internal assessment of the transactions against the indicators of suspicious transactions as defined by the Financial Intelligence Center Act (FICA), and if reasonable suspicion is formed, file a suspicious transaction report (STR) with the Financial Intelligence Center. Explanation: Scenario analysis. This scenario presents a professional challenge because it requires an advisor to balance client confidentiality with the potential need to disclose information that could prevent financial crime. The advisor must navigate the specific reporting obligations under South African legislation without breaching client trust unnecessarily or making unsubstantiated accusations. The challenge lies in correctly interpreting and applying the Financial Intelligence Center Act (FICA) and its associated regulations. Correct approach analysis. The best professional practice involves a careful, documented assessment of the situation against the reporting thresholds and indicators of suspicious transactions as defined by FICA. If the advisor, after due diligence, reasonably suspects that a transaction or activity is related to money laundering or terrorist financing, they must file a suspicious transaction report (STR) with the Financial Intelligence Center (FIC) in accordance with FICA. This approach prioritizes regulatory compliance and the prevention of financial crime while adhering to internal policies and ethical obligations. The advisor must ensure their suspicion is based on objective grounds and that the reporting is done promptly and accurately. Incorrect approaches analysis. Failing to report a suspicious transaction, even with a vague suspicion, constitutes a breach of FICA. This inaction allows potential financial crime to proceed unchecked and exposes the advisor and their firm to significant penalties, including fines and reputational damage. It demonstrates a lack of diligence and a failure to uphold the spirit of anti-money laundering legislation. Reporting every unusual transaction without a reasonable suspicion or based on mere speculation or personal bias is also problematic. This can lead to an overwhelming volume of unsubstantiated reports for the FIC, diverting resources from genuine threats. It also risks breaching client confidentiality unnecessarily and can damage client relationships. The advisor must have a justifiable basis for suspicion, not just a feeling. Consulting with the client about the suspicion before reporting is a serious breach of FICA. This is known as tipping off and is a criminal offense. It provides the client with an opportunity to conceal or move illicit funds, directly undermining the purpose of the reporting regime and the FIC's ability to investigate. Professional reasoning. Professionals in South Africa must develop a robust understanding of FICA reporting obligations. When faced with potentially suspicious activity, the decision-making process should involve 1. Identifying the specific red flags or indicators present. 2. Assessing these indicators against the definitions and thresholds provided in FICA and relevant guidance. 3. Documenting the assessment and the rationale for any suspicion. 4. If reasonable suspicion exists, filing an SDR promptly and accurately. And 5. At all times, maintaining client confidentiality unless legally required to disclose. This systematic approach ensures compliance, protects the integrity of the financial system, and upholds professional ethics. Question 20. Process analysis reveals that a client in South Africa, Mr. Thabo, invested R50,000 in a unit trust fund 3 years ago with a projected growth rate of 8% per annum, compounded annually. He now requires R10,000 for an unexpected medical expense and is considering withdrawing the full amount from his investment. If the fund has grown to R63,526.40 and incurs a 2% early withdrawal penalty on the total withdrawal amount, and assuming the projected growth rate would have continued, what is the net amount Mr. Thabo would receive if he withdraws the full R63,526.40, and what would be the projected value of his investment after 1 more year if he kept it invested? Option A. Mr. Thabo would receive R53,526.40, and the projected value after 1 more year would be R68,608.51. Option B. Mr. Thabo would receive R62,255.87, and the projected value after 1 more year would be R68,608.51. Option C. Mr. Thabo would receive R62,255.87, and the projected value after 1 more year would be R67,526.40. Option D. Mr. Thabo would receive R63,526.40, and the projected value after 1 more year would be R68,608.51. The correct answer is B. Mr. Thabo would receive R62,255.87, and the projected value after 1 more year would be R68,608.51. Explanation. Scenario analysis. This scenario presents a common challenge in financial advisory where a client's immediate financial needs conflict with the long-term benefits of a structured investment plan. The professional must balance the client's desire for liquidity with their fiduciary duty to act in the client's best interest, adhering to the Financial Advisory and Intermediary Services Act, FIS Act, in South Africa, specifically the General Code of Conduct. The challenge lies in navigating the client's emotional state and potential short-sightedness, while ensuring compliance with regulatory requirements for suitability and disclosure. Correct approach analysis. The best professional practice involves a thorough assessment of the client's financial situation, risk tolerance, and investment objectives, as mandated by the FIS Act. This includes understanding the implications of early withdrawal, such as penalties and lost potential growth. The advisor should then present a clear, fact-based analysis of the consequences of withdrawing funds, highlighting the impact on the client's long-term goals. This approach prioritizes the client's best interests by providing them with the necessary information to make an informed decision, even if it means advising against an immediate withdrawal that might seem appealing, but is detrimental to their financial future. This aligns with the FIS Act's emphasis on acting honestly, fairly, and with due skill, care, and diligence. Incorrect approaches analysis. Advising the client to withdraw funds immediately without a comprehensive analysis of the consequences fails to uphold the fiduciary duty and the principles of the FIS Act. This approach prioritizes the client's immediate request over their long-term financial well-being and neglects the advisor's responsibility to provide suitable advice. Another incorrect approach would be to dismiss the client's concerns outright without exploring the underlying reasons for their request. This demonstrates a lack of empathy and a failure to engage in a constructive dialogue, potentially damaging the client relationship and failing to identify any unforeseen circumstances that might necessitate a review of the investment strategy. Finally, pressuring the client to maintain the investment without adequately explaining the risks and benefits of both options, or without exploring alternative solutions, is also professionally unacceptable. This can be perceived as self-serving, prioritizing commission or fees over the client's needs, and violates the spirit of fair and transparent advice. Professional reasoning. Professionals should adopt a client-centric approach, beginning with active listening to understand the client's motivations and concerns. This should be followed by a detailed fact-finding process to gather all relevant financial information. The advisor must then apply their expertise to analyze the situation, considering regulatory requirements, product terms, and the client's personal circumstances. The outcome should be a clear, objective recommendation, supported by a thorough explanation of the rationale and potential consequences of each course of action. Transparency and open communication are paramount throughout the process.